Hi there, it's Brad Turville here, and welcome to this week's episode of TurvilleTV. TurvilleTV comes to you every Thursday at 12 p.m. Australian Eastern Daylight Saving Time, where I'm talking to you about all things business, finance, and investing. Some of our past episodes have included topics such as building personal wealth, getting financially secure, and looking at your business's organizational structure. And this week I'm coming to you live talking about making your business more attractive to a buyer. So we're now in July 2021. We're still somewhat in a bit of a COVID world and somewhat of a COVID environment. But there is a lot of activity in the M&A space, M&A being mergers and acquisitions. So a lot of businesses merging, a lot of businesses acquiring other businesses, a lot of businesses looking to sell, a lot of businesses looking to either put in place or execute or play out a succession plan. But there's also a lot of IPOs at the moment, initial public offerings. That's essentially when you are taking a business and you're listing it on the stock market, so it can be traded publicly on a stock market. I spoke to a lawyer in the last couple of days who specializes in this, and he was saying that they are swamped with work around preparing businesses at some of the foundational stages and some of the later stages in preparing businesses for IPOs. Also in trusted publications such as the Australian Financial Review or the equivalent overseas like the Financial Times. There is lots of talk about M&A. There's lots of activity in the space. I've got a feeling, and from what I'm seeing, that there are people out there looking to invest. I know I've got clients that are getting in and out of businesses, investing in other businesses, investing in assets. So there is a lot of activity at the moment, even though we're still in somewhat of a COVID type environment. I recall about this time last year, so around about May, June, July in 2020, we were only sort of 3 or 4 months into when COVID first hit. Let's remember, COVID came right at the end of March 2020. So the next thing we know, it was April. Things escalated from there, and then we went into May and June, and it probably only got worse. In those particular times, I helped a client of mine, well known in the fashion e-commerce space, completely exit from their particular business. An exit that involved them having to stay on to do a little bit of work, but only for a short period. So any preconceived ideas that everything was absolutely in lockdown and things weren't going on. Yes, industries such as tourism, airline, certain logistics, hospitality, retail were impacted. But there's a lot of other industries that either weren't impacted or they were able to adapt and pivot. Or there were still people going about their business, which is a good example here for this particular client that wanted to exit, and we were able to work and identify a group that were looking to acquire and wanted this sort of particular business and product and its results and some of the assets that it had. And regardless that COVID was going on at the moment, it was a good time for my client to exit because they could structure it in the way that they wanted. But the group that bought it, it was a good time to buy because they were in acquisition phase, and so they had a choice to either sit on their hands and do nothing for 12 months, which may not or would not have achieved anything, or just ignore that, yes, there's COVID on at the moment, but with this acquisition we're looking to make and the particular business model of that business, it was going to be quite uninterrupted in continuing to trade as a going concern, and not have too much issues with its supply chain. So that being said, a lot of activity around mergers, acquisitions, and selling your business. So what I find and what I have seen over the years in a lot of the selling of business, so working with a business owner that wants to sell the business, is most people have never sold a business before. In fact, most people have never bought a business or merged a business. But if you are in business, most of you listening or watching this have not sold a business before, and that's because you've either started a business, or you've bought a business, or you've bought into a business, and that would generally be for a longer term. And if you were to then look to get out of that business, there's two ways that you can go about it. One is selling it, but another one, which is not always the best, in fact, usually it's definitely not the best, is just closing your doors and walking away. So you're in business, you want to get out, for whatever reason you decide that is the best way to go about doing it. You just close your doors and walk away. You get out of the business, but you receive no consideration for that. Many business owners, when they're selling their business, the business isn't ready and it's not set up to be sold. There's also unrealistic expectations around how long it will take to get the business ready to have a smooth, or the smoothest possible, sale process. Things might not be in place where you can just step out and someone can step in. The business might be very much tied to you. You might not have fully maximized the value of the business, so the offers that you're receiving are a lot lower than what you would like, because you haven't got the business where you would like to get it to, but in your mind you think it's worth that future value, but it's not. It hasn't properly been set up and executed. And so it does take some time and require, some work and getting some advice and help from experts in mapping out what's the timeline and the milestone. So what's the roadmap for the exit look like? And even getting clear on who you're selling to. Are you selling to family? Are you going to sell to a private equity group? Are you going to sell to a competitor? Are you going to sell to a listed company? Are you going to sell to your management team? There's a number of different ways that you can go about doing it, and that might change the trajectory on how you're going to go about doing certain things depending on what that end outcome is going to look like. So one is around the time, but the second one is around the value, and probably more specifically, how much are you going to get and how much can you get on the sale of your business. And there tends to be a difference between price and value. Value is what it's worth. You might have an idea on what it's worth. Potential buyers might have an idea on what it's worth. Price is what you get. Price is, once it's done and cash is transferred into your bank account, that's what you come up with. That doesn't always equal the value. Okay, people that value it more than you might pay more. People that value it less than you may pay less, but they don't always match up. So because this isn't something that you've done before, and if you have done it before, you've most likely only done it once, and there's a very slim chance that you're perhaps ever going to do it again. It means that by default, most business owners have not got a lot of experience in it and haven't been through it in different ways, in different business models, in different sizes, in different types of economies, in different structures, to different buyers with different problems and complexities. There's a very much a lack of understanding there, purely because it's not something you do every day. Okay, think about the job that you have every day, whether it's running your business or it's working in the business or whatever it is. If you do that every day, you are just going to get good at it over time, purely due to practice and experience and being exposed to various things. But you don't get that in one setting a business up to sale and then going through the sales process. because for many people, it's a one in a lifetime exercise. So what I'm going to cover off on today is a couple of key points that I believe should be considered, should be put in place, should be part of your plan and your roadmap to start to make your business more attractive to a buyer. Now, if you're thinking, I'm not ready to, I don't ever want to sell, or I'm not ready to sell right now, that's fine, because what we're going to be looking at, some of the best practices, are going to help you build a much better business. It's going to perform better. It's going to be less reliant on you. It's going to have better systems and controls in place. So even though you might be thinking, I don't want to sell, I don't want to sell right now, going through certain steps of the process, you are building a much better business, which even if you stay in it for a long time, it's going to run a lot better. Around its productivity, around how you're involved, around the performance, which is things like revenue, ROI, what's profitability, strong cash flows, so on and so forth. These are all the things that business owners tell me they want in their business. It just happens that by getting them performing and being really well optimized, they also contribute to a more valuable business and a more attractive business to buyers. So you're really killing two birds with one stone here. So let's have a look at and start walking through some of these steps. Right. The first and most common problem I see in the majority of businesses is what is called key person sensitivity. And so in key person sensitivity, in key person sensitivity, what we're talking about here is the business being heavily reliant on you. Okay, you are the key person that is running the business. You're the key person that is making all the decisions. Excuse me while we deal with a small tech issue here. But the business is heavily reliant on you. And so because it's so sensitive to you, if you're not there, then generally you don't have a business. For you to make decisions and do certain things, it needs to be run past you. It needs to be okayed by you. If something is to happen to you, then perhaps the business is not going to be there anymore. Let's just get this up and running. We are very close to being back on track. PowerPoint, and we're back on track. Excellent. And so with key person sensitivity, this is going to drastically devalue and create certain risks in the business, because it's so sensitive to you being there or not being there. You know, so let's think about a business like, let's think about a lawyer or a doctor. The business is revolved around there. If you're the only doctor, then if you're not there, no one can come in and get help and advice, which they pay for, which means the business can't run and it can't generate revenue. If you were to sell that business, well, you would be limited in who you can sell it to, because you would have to really sell it to another doctor or another lawyer, because they're the only people that can deliver that particular type of service. You couldn't sell it to, let's say, an investor. You couldn't sell it to a company that wants to add an additional service offering to their business, because they would still need to go and find a lawyer and a doctor, which, hey, they might then be able to go and do. But if we compare that to a business that runs strongly without a heavy reliance on the owner, that's going to be much more valuable. It's now more of an asset than really somewhat of a job-like environment. So ways you can get around or start to manage key person sensitivity is build out your team, okay, and start to delegate a lot of the functions. I've done another video, it was 2 weeks ago, on organizational structure, and that's looking at the org chart in your business and the different functions and roles and responsibilities. And now, if you're a much smaller business and it's just you, you're going to be wearing every hat. That's a harder business to sell, or it's a harder business to get a higher price for. It's a harder business to have an easy and a smooth transition. Whereas if you've got a business that's built out with different heads of department and different team members and team leaders under them, all working and delivering in different functions, people marketing the business, people in the sales process, people in the delivery process, admin people to support everyone, finance people to do your payroll and your numbers and all your tax compliance. You might have outsourced HR to help with the hiring and firing and the performance management and so on. That's a sort of business where there can be a change in, let's say, the shareholdings, and the business is more set up to continue running as a going concern, even though, you know, you're not that involved anymore. So that is why this is one reason why smaller businesses don't receive as high of a multiple of profit on the sale of their business. And so just to touch on that, I'm using a bit of a rule of thumb here, but in many business valuations or business exits or coming up with the price of the business, a lot of the time, and I'm speaking quite general and broad here, a lot of the time there'll be a method used called multiple of profits, which is taking what's your profit times a number. That number might be times 1, times 2, times 5, times 6. So yes, you can increase your profit, but you can also increase your multiple. And generally, your profit is your profit, right? But the multiple, it factors in a number of things: scale, it factors in risk, it factors in ROI, it factors in how much someone really wants this and wants to buy this. It might factor in by someone buying your business and adding it in with their business, they get quite a lot of synergies where I call it 1 + 1 = 11, because by putting those two together, you don't get 1 + 1 = 2. By them coming together, you get much bigger opportunities in scale. And so in smaller businesses, there's generally more reliance on a key person, which is probably you, but also much more reliance on maybe a key team member, where if that team member is to leave, you're going to be in a spot of bother. You can also have key person sensitivity around a client. You might have, you know, $800,000 a year in revenue, but if $400,000 of that comes from one client, that's a risk, because if that client leaves for a number of different reasons, your revenue is now instantly halved. That's a massive risk. That's a risk for you just running the business, let alone if I was looking at a business that someone wanted to buy or sell, I would, you know, you'd be able to identify that buying the business, there is a risk that you could buy it and the $400,000 client goes elsewhere, and now you've bought an $800,000 business and you've already lost half of it. That's a big risk. Next, most businesses have got terrible financial reporting and financial controls. So in Australia, we've got a governing body called ASIC. It stands for the Australian Securities and Investments Commission. They have a number of functions. One of their functions, though, is they administer and are the governing body for voluntary administrators and liquidators. And they prepare a report every year. And in that report, they summarize, especially for SMEs, which is small to medium-sized businesses, they summarize the reasons why they have gone into liquidation. And so one of the top reasons, there's actually 3 top reasons. I'll give you all 3. The first one is a lack of strategic direction. That's one. The other one is high cash usage. And The third one is a lack of financial controls. Okay, so if they're the top reason businesses are going under, then do you think that some emphasis should be put on those particular areas? One, just to keep a viable and a good performing business, but number two, to get the business de-risk and a little bit more safer in how it runs, and when you go down the process of getting the business ready for sale, you need to get all your numbers up to date, not only historical, so how it has performed, but remember, if someone is buying your business, they're not buying the history. Okay, so if you turned over $1 million last year, they can't get that. That's gone. The last year's gone. They want to know, what is it going to make next year? Because if I own it, that's the year that I'm going to own it. So I want to know how it's going to perform then, or what about the year after, and so on and so forth. So having strong reports and controls in place shows a certain level of acumen, a certain level of diligence around the management of the business, that you're careful, that you're monitoring the numbers. You know, if you can pull out cash flow forecasts with different scenarios, if you can pull out and show monthly management reports with maybe an executive summary, sort of detailing and summarizing the findings of those management reports and those monthly meetings, even if you're just at the smaller size businesses. Is all of your tax obligations up to date? Are you using accounting software? Is all of that up to date? Is it all compliant? Can you easily pull numbers? Do you have KPIs that you monitor and track? How are you performing against them? What are some of the things that you're doing to look to improve a number of those particular indicators on how the business is performing? These are things that are going to be asked for in the process. Okay, so if someone came to me and said, I'm looking to buy a business, can you look at it? I would be asking for these sort of things. And depending how they come to me, how much comes to me, the in-depth layer they go to, how they look and presented, it's already given me a little bit of an idea. You know, has an accountant prepared it, or has someone just spat some reports out of zero, or they've just done something up in a spreadsheet? And that's giving me a little bit of an idea. Are they serious? Do you know what they're doing? Can I rely on these financial reports and controls? Is this all real, or is it made up? And so on and so forth. But you can also see how having tight financial reports and controls is going to help you run a better business. Okay, because the reason most businesses go under is mainly due to the financial side of things, and probably more so due to cash, which we're going to get to shortly. We're going to get to it very quick, actually. So cash. Businesses that have got strong cash flows are very attractive. Okay, so if we look at free cash flow, if we look at things like the cash conversion cycle, I haven't got time to go into them today, but that's essentially looking at, when you make sales in your business, how quickly is that cash coming in the door? Okay, so if I sell something today, am I getting paid for it today, or am I getting paid for it in 14 days, or am I getting paid it in 30 days or 60 days or 90 days? In fact, a large majority of businesses struggle or they go under, not due to profitability. Okay, a lot of businesses that go out of business or people close the doors, they're actually profitable. They just have got no cash, because people focus on certain things like getting invoices out, working in the business, but they then aren't focusing on getting paid and converting those invoices into cash. Cash is the lifeblood of any business. It needs a lot of respect. It needs a lot of attention. And businesses that have got strong cash flows, investors love. Okay, they're easier to run, they're safer, there's more cash surpluses. You can then look to do things like pay out dividends, invest in building a team, invest in capital expenditure. You don't have to either rely on a lot of debt, or if you have got debt, strong cash flows can help you manage and maintain and cover that debt or pay down that debt. So there's nothing worse than being tight on cash all the time. And from what I see in a lot of work I do in helping businesses with cash flow, is one, identifying what it looks like right now and what are some things we can do to improve it, but also giving you insights and ideas on where it should be. You know, I've got one particular CFO client that I work with, and a big takeaway they had was their cash flow was nowhere near where it should be. And for them, they thought it was already pretty good until we pointed out a number of things and then changed some processes to make their cash flows even stronger. And they had this facility where they could draw down another $300,000 in cash to run the business, where they haven't had to do that purely because we're able to convert more of what they're already doing into cash. So they don't have to just to keep going to the bank or keep going to investors and finding cash. Investors and buyers of businesses love strong cash flows. If I'm looking at a business, I want to see the cash flows. Okay, is this a business that's going to need a lot of working capital? Is this a business where you're going to have to put in a lot of money, or you're going to have to go to the bank and get extended facilities, overdrafts, line of credits, credit cards, things like that, just to keep the business afloat? Or are the cash flows so strong that it's able to stay on top of itself with relative ease? Another problem in a lot of SME businesses is they're under-marketed and they lack a sales process or sales structure. So a lot of people in business have got a particular skill. They're an accountant, they're a lawyer, they're a plumber, they're an architect. They might make certain things. They might make things out of wood, or they might be really good with steel and welding, and they can make certain things. You know, they might be in, like a metal fabrication or boiler making or something like that. And so they're quite good with their hands. So in regards to, you look at a business, you got the marketing of the business, then that's creating awareness and getting people excited and interested. From there, we're going into conversations to identify buyers that want to purchase, and then they are purchasing and giving you cash. And then from there, we're in delivery or operations, and that's where we're doing the thing. So an accountant is doing a tax return, a lawyer is drafting a contract of sale, an architect is developing the plans for the renovation that you want to do. The metal fabricator is maybe fabricating a special custom part for your motorcycle, or an engineering fabricator is maybe cutting and welding and fabricating some beams for a new outdoor area that you're building out the back of your house. So they're doing the thing that they do. A lot of people in business tend to be strong at the thing that they do, which is sort of the third step down the path. The problem that is identified, that I identify a lot of the time, is there's a lack of effective marketing, and then there's a lack of an effective sales process. And those two are required, because marketing is generating that awareness and generating that interest and getting your name out there. Okay. Sales is then taking all those inbound and outbound inquiries and engaging with people and identifying, what is your problem? Can we help it with you? What information do I need to provide to you? Do I need to book you in for something? Do we need to have a meeting? And then you're identifying if they're a fit for you, they're identifying if you're a fit for them, and then do we go to the next stage and actually go and do the thing? If we look at that from an e-commerce perspective, marketing might be a website, it might be social media content, it might be some paid advertising showing off the product and how people are using the product, case studies on the product. The sales process, it might actually be the website and the wording and imagery on the website, and there might be offers like buy two or get free delivery over a certain price, or so on and so forth. And there could even then be like shopping cart abandonment sequences, where if someone goes to buy but they don't, they might get a number of emails or particular ads shown to them to entice them to to come back. There's your marketing, there's your sales, and then the delivery. Someone clicks buy, and then you either receive a message saying so-and-so has bought and you now need to get the product, put it in a courier bag and send it, or it goes to a third party that holds your stock and they do that for you, and then they take a clip of each sale that goes through. So it doesn't sort of really matter what business model you're in. Are you in service? Are you in retail? Are you in some type of e-commerce mode? Just by a bit of a generalization, e-commerce businesses generally tend to be a bit better at marketing and selling. And I think because the product is they don't put a lot of focus into the product. Here's the thing that I sell, and they've got it, but we now just need to sell it. So the focus then just goes on to marketing and sales. Whereas in a lot of service-based businesses, the focus is on doing the work or keeping on top of professional development or learning new things. And you can get bogged down in the work, and then work dries up, and then you need to go back into marketing and sales. But there's also particular skills in marketing and sales. And people in marketing sales don't always have the delivery skills, and people in delivery don't always have the marketing skills. Doesn't mean you can't learn and invest some time there, but as an overall feeling, I see a lot of businesses are under-marketed and lack sales process and structure. And so that may mean for you to get a certain price for your business, there may need to be some emphasis on building out a better marketing function. So that might mean you need to invest some more cash into that area. It might mean you need to engage in a marketing agency to help you in the marketing of your business. Or it might also mean hiring marketing team members to come and work in the business purely in the marketing function. And the same goes from a sales perspective. In a lot of businesses, especially smaller businesses, the owner does a lot of the sales. And so as part of your exit, would it be a smart move to look to bring salespeople in-house and invest in some training and invest in building out a sales playbook and a sales structure for them to follow for the particular product or service that you offer and deliver? So under-marketed businesses and those lacking a sales process and structure will just result in you getting a lower price for the business. Great. Another one here is a lack of systems and procedures. Most businesses don't have systems and procedures. A lot wish they were more systemized and had documented policies and procedures, but a couple of things usually get in the way. Overwhelm, not sure where to start or what tech or tool to use, struggling to find the time to sit down and document certain procedures and checklists and how we go about doing things, or just bored or not interested in doing it. One or all of them are probably going to apply to you and apply to many businesses, even though logically thinking you understand the need to have that. You might be reinventing the wheel a lot of the time with different operations in the business or different interactions with clients. If you could just have a system that you could roll out every time, it's going to make you more efficient. Also, this gets more and more important when you've got a particular intellectual property. So that what I'm saying here is when you have a particular way of doing things, you might have a way you run your business that's so much more efficient and productivity than any of your competitors. And your competitors would love to do what you do, but they don't know how you do it. It's your secret sauce. It's your secret herbs and spices. You might have a particular product that you've built and worked with your suppliers on to tweak and engineer that no one else has. That is intellectual property that is specific to you and your business. You might have particular services that you offer that you've created, and you've R&D'd and honed them and tweaked them and updated them and improved them over time. But if that's just in your head, I can't sell what's in my head. I need to get it down in a framework, into a system, into a procedure, into a policy, into a way that we do things, into like a manual where I can give someone the manual and say, this is how we do it. Okay, this is how we manage to do this thing every week. This is how we manage to get our clients to do that. This is how we deliver this service that we charge twice as much as anyone else in the market. This is how we do all these different things. It needs to be documented. So one tip here around systems and procedures is the KISS principle, which is keep it simple, stupid, which essentially means you don't need any super fancy tech to at least to start the process. You can just start to document by writing down steps or thoughts and ideas, taking screenshots of your screen of, okay, we do this, take a screenshot, and then you go and do that, take a screenshot. You can also use cool things like Loom, Loom. I use Loom heaps, and it records your screen. It literally looks like what you're looking at right now. It shows most of the screen. It's got me in like a little circle. It can see me. It can see the screen. So if I'm going back and forth and showing things, it shows that, and it's recording my audio. And so you can start to build out some of these little walkthroughs, some of these little systems and procedures. If you haven't done it or it hasn't been updated for a long time, it's probably going to be a substantial exercise, okay? But it's going to be an investment. It's building an asset in your business. So if there's certain things that you want to hand over or delegate, then you can look to work with someone, and either you or them or both of you build out the systems and procedures for those things, which means if that new team member, they then ever go and bring on other people that are going to be helping them, they can then just give them access to the systems and procedures. And it's not like they need to be sitting there trying to unpack from their mind, this is how we do things. We've already got it in a manual. When buyers are looking at your business, if they can see a lot, if not all of the business is structured out in systems and policies and procedures, then they can see that this is a de-risking of the business. They can see this is going to help it run more efficient. It's going to be more effective. They can also perhaps see if they're a competitor, that might be one of the things they highly value. The competitor might want your team. They might want your office. They might want your brand. They might want your clients. But a lot of the time, they're going to want to know, how do you do these things? Okay, great. Well, part of us selling you the business is selling you our way of doing things. Keep in mind, again, reflecting back on selling the business versus getting the business ready to sell. By having strong systems and procedures, you are going to run a better business. People don't have to come to you as the owner to ask every question, because they can go to the system or procedure. When you bring on new team members, you can provide them with training manuals and so on, because you've built them out. They don't need to be shadowing you and sit next to you every 5 seconds and asking you every question. So it allows you to build our team, it allows you to scale, and it's an asset. Securing key employees. I know it's just cut off there, but it says employees. So in getting ready a business to sell, a lot of the time you want to make sure you have got your key team members on board and locked in. A lot of the time they're very important to the running of the business. They might have particular skill sets. They might have key client relationships. They just might be a fantastic manager. You might have taken a long time to train them up. The particular role might be hard to find and hard to fill. All of them are adding value. In fact, very, very few people recognize this. But I had it pointed out to me many, many years ago, and it's now something I always keep in mind, and I see it a lot. I was advising another accountant who was he was working for the owner of an accounting firm, and that owner wanted to sell, and he wanted to sell to this particular person who worked for him. And the owner was going to stay on and sort of slow down over time, but the accountant that I was advising was taking over, and we're looking at the business, we're looking at the assets, the revenue, the type of clients that they've got, the team, the premises, how it's performing, a number of different things. and they came up with a price, and they determined the price based on some financial aspects. But one thing that they didn't put a value on, keep in mind, I was not advising the person selling, I was advising the person buying. And my advice to the person buying was the vendor, which is the person that you work for that's selling the business, they haven't put any value on the team. Okay, so yes, there's the previous owner, and there was the accountant that I was advising, but then there was an extended team. There were other accountants, more junior accountants, receptionists, administration staff, bookkeepers. They hadn't put a value on the team, and so this accountant was not only going to buy into and take over the business, but as part of doing that, the team would transfer over to him. This team was a well-oiled machine. They knew the clients, they knew how things operated, they could do a lot of the work. There was much of a reduction in the reliance on a key person or key person sensitivity. And I just know experience in being in accounting myself, but knowing a lot of people and consulting to a lot of accounting firms. The biggest problem, one of the biggest problems, in fact, it could almost be the biggest problem, is the team. Getting the right people, getting a really well-run team and team structure in place is the hardest thing. And when a lot of firms think they've got it right, someone then leaves for a number of different, or something doesn't work out, or someone gets a better offer somewhere else and they go, then you need to try to refill the role. In this particular example, this guy taking over had an awesome team that he was inheriting, and the vendor had not put a price on that team. In fact, in looking at it, it probably would have been easier to go and build the revenue again than it would be to go and build the team again. But they'd put a price on the revenue, which was probably a pretty fair price, but they hadn't put a price or any sort of value or price or multiple on the particular team. And so this is an example where the vendor had security and structures around securing the key people, but then actually hadn't put a price on that. So securing your key people, having them aligned, and being there's a certain way you need to handle your team members when you're looking to sell your business. Okay, there's going to be different ways to go about it with different businesses and where you're at in the process and so on and so forth. But you need to handle that carefully, because that can derail things, especially if you've got something like, let's say, an earnout built into selling your business. Now, an earnout is will pay you over time based on the performance. So let's say I've got a business and I say this business earns $1 million in revenue per year. And I sell the business, and the person buying it says, well, look, I hope it does and continues to do $1 million, and you said it does $1 million, so why don't we structure it like this? For the next 2 years, I'll pay you out based on how the business performs. And if it performs $1 million per year, I'm going to pay you what you want, that you're asking for. But if it performs less than $1 million, then we're going to reduce the price that you're asking for, because you're telling me you can do $1 million. And if it can't, I'm not going to pay you the $1 million worth price. There's going to be a reduction in it. As you can imagine, if there were problems or complexities with the team and not securing team members, it may derail things, which will result in a reduction in potentially revenue, which then for you as someone selling the business is going to affect the price that you're going to get. That's probably one example. On that note, though, I'd be seeing how you could structure it so there is no earn out, but that's a separate conversation. And governance. I just wanted to see how many more we've got to go. Governance. So just quickly on this one, I know governance is a bit of a boring term, but governance is essentially, well, if you look at a business, you got management and you got governance. Okay, management is running the business. Governance is how the business is managed, okay, and the controls around those managing the business. So management are in there and they're doing the doing, okay, but then governance is how is it managed? What sort of controls have you got in place? What sort of checks and crossing the T's and dotting the I's, and what sort of structure are you running monthly board meeting? Are there certain controls around who has access to bank accounts, and who has certain details to client details? And is the person processing the payroll someone different to someone, transferring the cash? In regards to governance, do you maybe have independent people that sit in on the company? And this is still stuff you can do as a small business. Don't think governance, this is only for big corporates that are doing $100 million to $1 billion per year. No, these are things that you can have in your small business. So a lot of small businesses have like a mentor or a mini advisory board. And then a mini advisory board might be yourself, another industry expert. It could have a lawyer, and it could have an accountant or a CFO on the board. And that's to get together every month or every quarter to challenge you to look at the business, to use the board as a sounding board, for them to come to you with the things that you don't know, for them to point out areas of risk or security. So governance again is, and the next slide we're looking at is de-risking the business. But governance is also about risk and risk management. So what are some of the risks in the business? It could be around you, it could be around the team, it could be around the structure, it could be around certain investments, it could be around products. There could be a range of different things. So looking at how is the business, how do we run the business, but how are then those in charge of the business held to account? This gets more important as you start to bring people in to help you run the business. So if you maybe bring in a general manager, they're looking after the marketing people, the sales people, the delivery people, the admin people, and they're putting out the fires, they're dealing with a lot of the day-to-day operations. A lot of things are happening without you being involved anymore, but you obviously want to make sure you're not being ripped off. People aren't stealing from you. There aren't certain risks that are building, which if they unravel are going to cause massive issues in the business. The way you go about doing that is having certain procedures and checks in place and certain structures to help with accountability and risk management. And the last one here is de-risking a business. So businesses that are less risky, are going to be more enticing and more attractive to buyers. So if you've got strong cash flows, the business is less risky. If the business is either not reliant or less reliant on you as the owner manager, the business is going to be less risky. If you have maybe something like all of your clients on recurring revenue engagements where you're paid monthly and they're locked in for 12-month contracts, that is de-risking the business. If you've got a bigger, well-structured team as opposed to a very small team reliant on one or two people, the business is going to be less risky. If you have had a legal audit by a lawyer, and they've identified some issues, and then you've implemented their recommendations in advice and tighten up the legal side of things, the business is less risky. If you're staying on top of all your tax obligations, and when there's certain things you get taxed advice, so there's a number of things here that you can start to do to de-risk, and you're probably already going to know some of the risks in your business. You could also look at something called the Porter's 5 Forces, which looks at 5 different factors in regards to certain aspects of your business. One thing is the barriers to entry in your business. The other one is bargaining power of customers. Another one is bargaining power of suppliers, and so on. So part of a process of making a business more attractive and looking to build the multiple or build the price or the favorable terms you can get on the sale or exit of your business is by reducing certain risks. So that is rounding us out for time, but also in regards to the key areas that I wanted to cover off on today. I've gone sort of high level and then drilled down here and there, giving you a few ideas, distinctions, case studies, and so on and so forth. Just getting the creative juices flowing and getting your ideas starting to flow a little bit around getting a business ready for sale, you are probably already starting to think and can see and identify that some of the things that came up today are probably areas where you need to put a little bit more focus on. And recall I said earlier, even if you're not ready to sell the business right now, as in today or maybe in the next few years, by implementing some of these ideas and some of these processes, it's going to help you run a better business anyway. So you might not be ready to sell, but I'm sure you're going to say to me that you would like to run a better business. Some of these ideas are going to do both for you. And so if you are to implement certain things and you are seeing an upside, and then circumstances change, or out of the blue someone contacts you and they make an offer or they're interested in buying, you are going to be, one, in a better position to have the business a bit more ready to sell, but two, have the performance of the business being a bit more attractive, which is just going to result in a bigger check that's going to go in your pocket than otherwise. If you would like more help with this, please reach out to me. You can comment below. You can visit bradturville.com. You can visit bjtfinancial.com. It is a hot time for M&A and IPOs and business sales and acquisitions, and there's a lot of ways you can go around doing it. There's a lot of upside and a lot of potential in doing it. In Australia, there's a lot of, in certain size businesses, there's a lot of tax provisions that you can access to reduce the tax on the sale of businesses and so on and so forth. So I hope today has been helpful. I look forward to seeing you again next week, 12 p.m. Australian Eastern Daylight Saving Time, where TurvilleTV will be coming on again, talking all things business, finance, and investing. I'm Brad Turville, and I will see you next Thursday.